A bond ladder is a way to turn a lump sum into a schedule of future cash without locking every dollar into the same maturity date. That matters because bonds create two useful cash flows: interest while you hold them, and principal when they mature. Instead of guessing where rates will go, you spread maturity dates across several years. Imagine putting all $10,000 into a 5-year bond. If you need $2,000 in year 2, you may have to sell early, possibly at a loss. A ladder avoids that mismatch by placing part of the money in a bond due each year. When a rung matures, you can spend the principal or reinvest it. The main value is control. A bond ladder does not eliminate risk, but it gives every dollar a planned job and turns unpredictable market decisions into a repeatable cash flow process. For this 5-year example, divide $10,000 into 5 equal rungs of $2,000. Buy securities scheduled to mature in about 1, 2, 3, 4, and 5 years. Equal sizing keeps the lesson simple and creates a $2,000 principal event every year. The reason this structure works is that no single interest rate controls the entire portfolio for the full period. The short rung returns cash quickly, while the long rung locks a rate for longer. Picture a calendar with $2,000 arriving in year 1, another $2,000 in year 2, and so on through year 5. Those amounts are principal, not profit, so spending them reduces the ladder. Reinvesting each maturity maintains it. The essential point is that the ladder starts as a portfolio of staggered promises, each tied to a specific date and a specific cash flow decision. Use securities that match the purpose, because a ladder is only as dependable as its rungs. For a high-quality cash flow ladder, U.S. Treasury securities are often a straightforward choice. They have low credit risk, broad liquidity, and known maturity values if held to maturity. For clean math, assume our 5 positions are bought at face value, are non-callable, and have coupons matching their stated yields. Actual Treasury bills can be sold at a discount. Treasury notes generally pay interest every 6 months, and market purchases may be above or below face value. A corporate bond offering a higher yield may look attractive, but default risk or a call feature can interrupt the plan. An FDIC-insured CD can also fill a rung when its terms and insurance coverage fit. The rule is simple. Choose the maturity date first, then evaluate safety, liquidity, taxes, and yield, rather than chasing the highest quoted return. Now attach illustrative rates to the 5 rungs. Suppose the $2,000 1-year security yields 4%, the 2-year security yields 4.1%, the 3-year security yields 4.2%, the 4-year security yields 4.3%, and the 5-year security yields 4.4%. These are teaching assumptions, not current quotes or guaranteed returns. At face value, the estimated annual interest is $80, $82, $84, $86, and $88. Together, the latter produces about $420 of interest during a full year before taxes, assuming every position remains outstanding for that year. The exact arrival dates depend on each payment schedule, so $420 should not be mistaken for a smooth monthly paycheck. The useful lesson is the separation between income and principal. Interest is the return generated by the ladder, while each $2,000 maturity is returning your own invested capital. When the year 1 rung matures, the ladder reaches its most important decision point. You receive about $2,000 of principal, plus any final interest due, and decide whether that cash is for spending or renewal. If the goal is a continuing ladder, use the $2,000 to buy a new 5-year security that matures in year 6. The original year 2 rung now has about 1 year remaining, and every other rung moves one step closer. In year 2, repeat the process by extending that maturity to year 7. This rolling method matters because it keeps access to principal every year while gradually exposing the portfolio to current rates. If new 5-year yields are 5%, the renewed rung captures that higher rate. If yields are 3%, only that rung resets lower. Reinvesting at the far end preserves the ladder and prevents a single rate decision from controlling all $10,000. Cash flow management begins by matching maturities to actual expenses, not by assuming every maturity is income. If you need $2,000 for property taxes each June, choose a rung that matures several days before the bill, then hold the proceeds in cash until payment. That timing reduces the chance that settlement delays or a market holiday disrupt the plan. The distinction between spending interest and spending principal is critical. With our assumptions, the latter generates about $420 of annual interest before taxes, so it cannot fund $2,000 of yearly spending forever without shrinking. Spending the year one principal leaves only $8,000 invested. Spending another maturity in year two leaves $6,000. A sustainable plan, therefore, labels each maturity in advance as spend, reinvest, or partially reinvest. The point is to build the latter around a cash flow calendar, because dates and spending needs matter as much as yield. A ladder helps manage interest rate uncertainty because it replaces an all-or-nothing rate bet with gradual reinvestment. When rates rise, existing longer bonds may fall in market value, but a maturing rung soon gives you cash to reinvest at the higher yield. When rates fall, new rungs earn less, but older rungs continue paying rates that were locked earlier. For example, suppose rates jump from about 4% to 6% after year one. The entire $10,000 does not reset, yet the matured $2,000 can capture 6% in a new 5-year bond. If rates instead fall to 2%, only that renewed slice takes the lower rate while the remaining rungs retain their original terms. This balance is the reason ladders are useful. They do not predict rates or guarantee gains, but they spread reinvestment risk across time and create a disciplined response to both rising and falling markets. Holding to maturity is the foundation of the plan, because selling early can turn a known maturity value into an uncertain market price. A bond due at $2,000 can trade below $2,000 when rates rise, and credit concerns can push a corporate bond down even further. Keep a separate emergency reserve so an unexpected repair does not force a sale. Also check whether any bond is callable, because the issuer may return principal before your planned date, often when reinvestment rates are less attractive. For example, a 5-year corporate rung paying 5.5% might be called in year 2, leaving an empty spot in the schedule. A non-callable treasury avoids call risk, although inflation and early sale risk still remain. The practical point is that a ladder creates reliable cash flow only when the securities, maturity dates, and reserve fund support holding every rung until its intended exit. Execution details can change the real return, so read the order screen rather than relying on the advertised yield. Bonds may trade above or below face value, and a broker may display price per $100 of face value, accrued interest, minimum quantities, and a bid-ask spread. A $2,000 allocation, therefore, may not buy exactly $2,000 of principal. For example, a bond priced at $101 per $100 of face value costs about $2,020 per $2,000 of principal before accrued interest. Taxes also matter. Treasury interest is generally subject to federal income tax, but exempt from state and local income tax, while corporate bond interest may be taxable at all 3 levels. Account type can change the timing of taxes, confirm settlement dates, payment dates, call terms, and total cost before placing each order. The point is to measure the latter by after-tax cash flow and usable maturity proceeds, not by headline yield alone. A successful $10,000 5-year bond ladder is built around dates, not forecasts. Split the money into 5 $2,000 rungs. Select high-quality non-callable securities maturing from year 1 through year 5, and record every interest payment and maturity on a cash flow calendar. Our hypothetical rates produced about $420 of annual interest before taxes, while each $2,000 maturity represented returned principal. When a rung matures, spend it only if that was the plan, or reinvest it into a new 5-year rung to keep the ladder running. Maintain emergency cash. Avoid forced sales. Compare after-tax yields and verify price, accrued interest, and call terms before buying. That process gives you predictable decision points without requiring a perfect interest rate forecast. If this example made bond ladders clearer, like the video and subscribe. Comment with whether you would use each maturity for spending, reinvestment, or a mix of both.